Hi, folks. This is Sean Hyman from SeanHyman.com. And if you are viewing this from somewhere else, Facebook, Twitter, or through email or social media, with somebody passing this along to you, you can reach us at SeanHyman.com. That's SeanHyman.com, SeanHyman.com to get some free information on several of the tabs on the site, and also if you want some specific direction as far as the broader market and as far as specific stock recommendations, I do that too in the premium section of the site that can be subscribed to as well if you wish also. But I just want to give you this video today to hopefully teach you some stuff to help prepare you for what's ahead, because we have likely just entered the bear market that that many have been talking about the possibility of coming for a while. The market overall, this is the S&P 500. Most people bought the S&P 500 in the past year. If they bought any in it, they typically did it at or above this boxed level. So there's only like there's a day here where it went lower than that throughout a portion of that one trading day. And then there was this one little spike low here, and you could even say maybe just a hair there on a couple of other partial days within the whole calendar year that are the only things that are slightly below that. So 99% of all investing or trading activity happened above that box. And the problem is today we dropped below that box. And so what that means is, for the most part, pretty much everybody who's bought and held the S&P 500 index, which is the 500 largest companies in America, or any mutual funds or index funds or ETFs that are influenced by the S&P 500 or loosely tied to it or linked to it, they're all likely down on their money for the year. And that's the first thing that really gets people to thinking and reassessing, because before that, unfortunately, people usually think, well, I don't need advice, and they think they're a genius because you can pretty much throw a dart at anything and it went up because there was a broadly rising overall market. So bad stocks and good stocks alike were rising. And now in a bear market, which is where you start to have let me see if I can draw this. There we go. I pulled the other off, and so you could kind of draw a trend line one of a couple ways. You could draw it that way. You could draw the more aggressive trend line that way over the past year. And it looks like the market has topped out last September and has been on the decline ever since. And of course, you hear more and more talk about this these days, which is the death cross, which is where the 50-day moving average crosses below the 200-day moving average, that's a medium-term averaging of what the market's doing with a long-term averaging of the prices of what the market's doing. And when that medium goes below the long-term, that's when you typically have a confirmation of a trend change, which so far has borne out with lower highs and lower lows, which is another sign of a bear market as well. But if you were to go back and look at the last 2 years of trading activity, you still really get a very bearish picture as well, because if you were to draw the trend line that connected the most major lows, and again you could draw it there, or you could there's a few different ways it could be drawn, and you still come up with about the same point at which it would break on this side, which is right in here, which is just above the death cross. So you've got a 2-year trend line break and the price trading below these moving averages and a death cross, and pretty much anybody that has bought and held for a little over a year is down on their money. And with the way these things accelerate over time, it'll be fairly soon to where anybody who's bought and held over the last couple of years will be down on their money. And so that really gets people to thinking and reassessing, where things are at for their portfolios. And why do bear markets even happen in the first place? Well, they happen because prices can only go so far away from the average earnings of a company. And so let's just say that earnings are, growing at something like this. Let's just say, for instance, earnings don't, typically go parabolic like you see these moves with a stock. But when the price moves so far away from the earnings, even if the earnings are growing, if the price just parabolically moves away from that, it has to come back to more of a fairer value in line with its earnings and then some. Of course, in bear markets, you'll have stocks drop way below even their earnings, even though earnings start to, they start to plane off and start to decrease a bit. You'll find that stocks, drop, way below that area before kind of snapping back to what's closer to their declining earnings even. And so it's just like in housing. If home prices can rise, but home prices can only rise a certain amount relative to where wages are. So if wages haven't risen enough to where people can pay the mortgage payments for those higher priced houses, even if they wanted to buy, they can't buy because it's gotten out of the range of what their ability is to pay through their wages. Well, so the prices have to fall and correct and come back down to something fair, and that's something we are just starting to see, I believe, happen in the housing market. Is some topping there as well, and prices self-correcting also. So you've got two wealth creators, home prices and stock prices, that stock prices have likely entered a bear market, and home prices may possibly have begun a downtrend as well. And so I want to show you, just taking a look at the last bear market in stocks. This is the S&P 500. The last bear market topped out with the S&P 500 at about 1576 in about October of that year. And people always think, well, when the market corrects a decent amount, you should just buy that dip because after all, it's so much cheaper than what it was before. And 1400 looks cheap compared to 1576. Only problem is in a downtrend, it gets far cheaper before it ever turns around and gets more expensive. So it goes to the 1200s, and then to 1400s, and then to 1200 and 1300s, 700s, 900s, and then the dreaded number of 666 before it finally bottoms. So, and then that was the bottom. It turns around, but look, when this pulls back 10 or 15 or 20%, and people think it's a bargain because it's that much off its highs. But I'll remind you that it went from 1576 to 666. So it almost lopped 1,000 points off of a 1,500, almost 1,600 point index. And so, and that happened in what, a year and a half's time. So one, downtrends can last longer than you think. They can do more damage for longer than you think. The emotions will get extremely heightened in the bear market. And it's a place where you're going to want some guidance and where cooler heads will prevail, and somebody that'll keep you on a more mature-minded path as it concerns your investments. And even my own subscribers, honestly, because many of them are younger investors. I don't mean younger in age, but I mean younger in how long they've been investing. And even they, without the proper direction, and even with the direction, it will be a challenge for them. Because really, in bear market downtrends, that's really what separates the men from the boys and the women from the girls, so to speak, is how well they learn to handle the emotional challenge of a bear market downtrend. Because it seems like the sky is falling, and there's certain points within these downtrends where it seems like every day they turn on the TV, that Fox Business, CNBC, Bloomberg, whoever they listen to, is telling them that, you know, stocks are down and things are grim and earnings are getting worse and the economy's getting worse and more layoffs are happening, and all that will be happening during a down market. And we have a plan of attack. It's a long-term plan of attack. There's nothing get rich quick about what we do. This is true investing, what we do. But we have a long-range plan of attack of how to handle these all this volatility and these bear market downtrends to our advantage to position ourselves for our long-term success. So with that said, I want to just remind you, with a longer-term look, this is the S&P 500. And you know what? Actually, I'll switch to the Dow, because many people are, even though the S&P 500 is the 500 largest companies in America, and a broader look at what people will experience, the Dow Jones Industrial Average, which is really only 30 mature stocks, it's the levels that more people are used to hearing quoted. So I'll switch to that real quick. So the Dow on the last bear market went from above 14,000 to 6469 before it ended. The one in 2000, the crash there, went from 11,750 down to 7179 before it ended. So these are like 40 to 60% drops from peak to trough on the bear markets, and they last a while. They'll generally last a good year or two. And when stocks are going down overall throughout that period, it seems like an eternity for sure to the novice investor, but for really everybody at that point. And here we are again with declining technical indicators, which show the upward momentum is turning and is likely ended. And here we are at a major area of support that's been broken, this 24,000 level on the Dow. You know, I had a friend of mine who is, you know, a good friend, but a non-financial person. So he's not in the financial industry, and had such strong conviction that the market was going to continue to go up. And I said, what would be your reasoning behind that? And he says, well, the Dow hadn't been below the 24,000 mark for a while. That was his sole reasoning behind why he feels that the market would continue to go up. And what you'll find is novice investors and non-investors get their opinions from the market. One, from the media, which is always looking, the media is always looking in the rearview mirror, telling you what has happened and what is happening, but they really don't have an effective way of telling you what they believe will happen. And that's what my job is. And it's like driving your car by exclusively looking through your rearview mirror. So novice investors, which are the average mom and pop investor out there, that are your plumbers and teachers and electricians, and they're great at their professions, at what they do, but they're not pros in the stock market. They get their feeling for what the stock market is going to do by what it has done. So they drive forward by looking in the rearview mirror. And the problem is they felt very good about the market over these last few years, because we've had one of the longest running bull markets in the United States history. And so the Dow went from 6469 to over 27,000. And I've got a video on my site that says, are you ready for the next 10,000 points to be shaved off the stock market? And that's because I believe that the Dow could easily go, at a bare minimum, from 27,000 to 17,000, if not far below that. Because what you'll notice is, and some of you will know what moving averages are, and some of you won't, but just use it as a visual, this red 200-week moving average. When there's bear market downtrends, the stock prices don't stop at this moving average like they do in uptrends. They go far below those prices in bear market downtrends. And so you see that here with the price getting into 7,100s when the moving average is back at 10 or 11,000, and you've got the moving average here, probably, 11,000 or so, but you got the price falls to 64.69. So, the point is that the price of the Dow can fall thousands of points below even where the moving average is. So you've got the moving average right now at 20,674, which as the more prices decline, that'll start to plane out and even head lower. But thousands of points below that would I mean, this could easily go to the 17,000 range on the Dow before it's all said and done. Could it go more? Sure, anything can happen. It can definitely go more. But I think at a bare minimum, it does that. And that will be very painful for a lot of investors, and a lot of investors will not know what to do. They'll panic. They'll hold on to these stocks and just ride them all the way down, and finally they usually throw in the towel and say, I'm never investing again, right in this area where the bottoming range happens, and then months to a year later, things take off and sort of new highs again without them. And that's how your average mom and pop investor deals with bear markets. They just don't have a plan for bear markets. They really don't have a plan for up markets, but up markets take care of themselves. So you don't have to be a stock market genius to make money in up markets. And so a lot of people confuse genius with just simply being a participant in what was an overall upward flowing market to begin with. Well, we know this past week that more money flowed out of the stock market than at any given time in the past, and that started the outflows, and that starts a lot of things like margin call selling from brokers, which are people who have borrowed money from the broker against their stocks to buy more stocks, and they are leveraged, and the brokerage firms to protect their own selves when stocks fall to a certain point, they have to go in there and sell out certain positions if the client hasn't done it already. And so you get margin call selling, you get fear-based selling, you get people selling because they didn't know what they bought in the first place, they just knew it was going up, and when it's going down, it scares the pants off of them, so they sell. And so that unwinds for quite some time. And people will go on TV acting like, oh, well, the market's fallen 10 or 20%, so the bottom must be in. And I'm going to tell you, if you ever study bear markets, they don't end real soon. Here you had 11,750 at the peak here in 2000. And when did the bottom come? The bottom comes in late 2002 at 71.97. Here you are, in around, I think it's September, November, somewhere in there of 2007. And when does the bear market end? It ends in like March or something like that of 2009. And so these things last a while. They last longer than you think they will. They go further down than you think they'll ever go, because people, the thing about bear markets is they're usually so far between bull market. Bull markets put so much distance between the bear markets that the people who were in the last bear market kind of forget about the length of time and the amount of pain that those can bring about. And so they forget how far stocks can fall, even good stocks, because keep in mind when you've got the S&P 500, which is the 500 largest companies in America, when people are selling out of those S&P 500 index funds and S&P 500 index ETFs, all those 500 companies are getting sold across the board. The good ones, the stronger fundamental ones, the weaker fundamental ones, whatever, they're all getting sold en masse across the board. And so it creates something that becomes a very sentiment-driven, self-fulfilling prophecy. More bad news and more negative sentiment brings about more bad news and more negative sentiment, and it starts this negative feedback loop that takes a long time to run its course between like what ends up happening is that bad sentiment and that negative feedback loop happens for so long until stocks get so dirt cheap to where they're so far below what would be a fair value that pros start to finally come in and buy, because mom and pops are scared out of their gourd to buy when stocks have been declining for a year or more. And so they won't do it. But pros will go in there and start accumulating shares again while everybody else is scared out of their pants. And we'll start accumulating shares when stocks are really just stupid cheap relative to fundamental metrics. And they'll have a strategy just to start buying in, just like we do in ours. And those the bleeding doesn't even usually begin to stop until what I've got down here noted as the VIX, which is the volatility index. It measures the volatility of the S&P, and until the VIX ratings spike up to about 40 or more, history has shown that these things don't even think about coming near their end. And even once they do spike to that, they can still drop, 15 or 20% even more even from those points. And there was one time in history where the VIX, went to almost 80 or so, or maybe a little above it. I think if you don't use the line chart and use the candle chart, I think it was 89, I believe, was the top, and the VIX where this bottom was here. So the way the VIX works is, the more a downtrend goes, the more volatile it gets, and it measures that volatility. So as the volatility increases, it spikes higher. So as these downtrends, as the S&P goes down, the VIX goes up, and once it usually gets to around 40 or more, you start to get in a period where the fear is great enough in the index to where it's time to finally start nibbling away at stocks once again, and doing it in an averaging down fashion like we do in our newsletter. And so more of that if you are more on that if you're a subscriber. You can find out about that in the premium newsletter section. You can subscribe to that if you want to, just by clicking on premium newsletters at SeanHyman.com. Click on any video or newsletter and scroll to the bottom of the page and click on the sign up button, and for $197 a year. So it's very cheap monthly. You can get 12 monthly newsletters with exact recommendations that are within them, and exact buy signals for stocks, and exact sell alerts as well for stocks also, and weekly videos that accompany those as well each Thursday. So I'm just trying to warn you more about this, and this is not a sales, it's not a marketing campaign for my newsletter, but it's really to warn you about what is unfolding. And so I want to show you just real quick, even what some very large, very widely held, very good stocks, and even some commonly held stocks that maybe don't have such great fundamentals but are commonly held, how they can act and fall in a bear market. So let's start with one that a lot of people just haven't had a history of thinking could fall hardly, and that's Apple. Apple on its recent highs was at 232.66 and is now already in the 160s. And this is one that I said I believe even Warren Buffett made a mistake in buying because he bought it way up high, and I believe he's now down on his money on that one, and it's got a lot further to go. Anytime prices get far away from these long-term weekly moving averages, particularly this red one, the risks are high. The chances of a downdraft versus how much upside it has is really kind of a flipped risk or reward against you, and you just really don't want to be a part of that. And so that's one of the ways that we dodge a lot of bullets in our investing. We first invest based off the fundamentals, which are the fundamental soundness and size of a company, how big it is, how much cash it has, how little debt it has, et cetera, how much it earns in earnings and that sort of thing. But we also have visual metrics known as technical indicators that can keep us out of a lot of hot water as well. So Apple in the last downdraft went from 25.61 down to 9.98. And the one before that was, of course, this is all split adjusted, but, went down from $4 to, I think it's saying like, 10 cents there, 90 cents there. So, I mean, huge percentage drop. Matter of fact, I think we'll be able to see these if I switch this to logarithmic. Yeah, there we go. And so, so for a little over $4 to about 84 to 85 cents. Sorry. But massive drop there. Okay. So let's look at some others that are widely held. Microsoft is one that a lot of people have been touting recently. Oh, it can do no wrong. It's doing great. It's larger market cap than Amazon and blah 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 right now. And so it's been as high as 115 lately, and look at where it is relative to the smoothing average, and a huge distance there, lots of downside risks that a lot of people are not paying attention to. But what did it do in its last couple of bear markets? It went from 28.64 down to 11.68, so more than cut in half over that time. In the 2000 bear market, it went from 39.60 to 13.29. So again, massive, massive difference. So when people think these things can't fall a lot, even big, huge companies that will survive and make it long term, they get punished big time in these bear markets. So Amazon went from 101 to the 34s. So I mean, it had a third of its size left after that. I mean, massive fall. Here it went from 113 to 5.51 in the crash of 2000. So I mean, that's just how brutal it can get. Let's look at some mature banks, like probably one of the most widely held and widely revered banks out there, Jpmorgan Chase. In the last bear market, it went from 40.64 down to 12.06 before that bear market ended. Just brutal. In 2000, it went from 43.27 down to 10.31. So, I mean, you can see to where in bear markets, these things can go to where they are, a third or a fourth or even sometimes worse of what their highs were just, a year or two earlier. I mean, that's how brutal they can get, and a lot of people are just simply not prepared for that. And by the way, they think the world's coming to an end when that's happening, and all these get sold off, but it really has little to do with their fundamental true value, and that's why in less than a year or sometimes a year or more, it can also go from 12 to almost 40 and 10 to 25 or 30 and so forth once all the bad has been over and the new uptrend starts again, because the stocks weren't anywhere near fair value to begin with in the downdraft. So just as stocks get overvalued towards the top of uptrends, they get grossly undervalued towards the bottom of downtrend. So if you learned in college and in your universities, you had a professor that taught you that there's efficient market hypothesis, and that there's the market is always trading at a fair value of what it should be at. I'm here to tell you that your professor is widely mistaken. I mean, he's badly mistaken, and that's why he's a professor and not an investor. But I've been watching markets for over 25 years, and so I can tell you that what they teach in colleges and what they're teaching your kids and what you probably taught is just simply not true in real world economics and real world markets. I'll get it out in a minute. Sometimes I talk like George W. Bush. I get a little tongue-tied. So J&J, Johnson & Johnson, went from 53.11 to 34.32. In 2000, it went from 32s to 20s. So, it was a little bit more of a defensive stock, and even it got hit, pretty good. Bank of America, BAC, went from 44.15 to 2.31 in that last. I mean, can you imagine 44s to 2s? And then just to show you how that, 44 was obviously overpriced and 2 was obviously underpriced. And, a year or two later, it's back to, $18, $19 a share. And then, goes back to 4s and back to 17 and on and on. I mean, it has wild swings after bear markets many times. Let's look at Netflix, which wasn't around for the 2000 bear market, but was around for the 2008 bear market. And that one went from split adjusted 5.84 to 2.55. So, basically a cutting in half there. So, and that could easily happen again. It's just on a bigger scale on a per share wise, but that kind of a sell off could happen once again. And that's not uncommon for, these types of stocks anyway, but certainly in these bear markets. So no matter how big, no matter how popular the name, I mean, I've spouted off a lot of common, widely held names that to today. None of them were immune to it. Here's Google, one of the biggest companies out there. It wasn't around for the crash of 2000. Well, actually, I'm sorry, it was under a different ticker symbol. But in the crash of 2008, what did it go from? 373.98 to 123.77. So just another huge one. By the way, let's look at Berkshire Hathaway, the most expensive stock in all of the stock market, Warren Buffett's company. The A shares at the time were $151,600 at their peak in late 2007. And when everything was said and done, it had cut in half, at least at $70,100 per share before it finally came to a bottom as well. In 2001, in the crash of 2000, it went from a little over 81,000 to 40,800. So again, another almost cutting in half, or actually no, a little over cutting in half for the most expensive stock per share in the entire stock market, run by what's arguably the world's best investor, BRKB. If you look at what they call the baby Berkshires, which are the B shares, that same thing happened. They went from 101 to 44s. They went from 54s here to 27s, etc. So we are set up for something of that nature to happen again. So the point is that most stocks will go down in a bear market, no matter how fundamentally sound they are, how big they are, how much cash they have, how much they have in earnings, because they are not fundamentally driven moves as much as they are emotional and sentiment driven moves. That there is a plan and a way that we have to take advantage of those downdrafts and that volatility in the Logical Investor newsletter. That is a long-term solution. It's certainly not a near-term solution, but a long-term solution, and will help you manage bear markets. By the way, my subscribers have held a lot of cash, and they've got huge percentage amounts of cash sitting on the sidelines, so they haven't largely been exposed to these large downdrafts that we've seen in the Dow, coming from 27,000 to 23,592 as of this recording and stuff like that. So they were warned ahead of time of the risks that were out there, even though the market was up and wasn't showing most people any signs of anything cracking. I was telling them that, with this RSI dying off, with this MACD dying off, showing the momentum shift, with the price here being far away from the 200-week moving average, and with looking at price to earnings valuations, which tells you the average price of the index versus its average earnings within the index, those being at crash level highs, that the risks were enormous for the overall market, even though it doesn't feel like there's enormous risks until it's too late. In other words, as the Dow went from 10,000, 11,000, 12,000, 13,000, 14,000, it didn't perceive, there wasn't a perceived risk. It didn't feel like there was any risk. Why? Because the market was going up. But yet it had gotten to those extreme valuations. It had gotten to those huge technical risks, etc. And the problem with how most investors are led by how they feel about the stock market. By the time they get to feeling bad about the stock market, half their portfolio is gone, and then the rest is such fear-driven, they try to hold on, and about half to two-thirds of the way through the bear market, they're selling out and locking in their losses because they think that the stock market's going to disappear, and so is their wealth, and it will if they lock it in. I mean, they're locking in losses and shouldn't be, and they have no faith in the future because, remember, they're always driving in the rearview mirror, and all they see is the down cycle. And so when they see the down cycle, that's all they can think will ever happen is stocks going down. Just like when stocks are going up, they're driving in the rearview mirror there thinking there's no way that stocks can go down. Why? Because we got years of telling us that stocks went up. So they're always driving in the rearview mirror, and they're always basing their investing decisions off of how they feel about the market. And emotion is a horrible leader. It's an okay follower, but it's a horrible leader, and it should never be the reason for your investing. Well, that's why we use fundamental metrics that are measurable, numerical. And then we also secondarily use technical metrics, which are measurable and have no biases and that sort of thing. And so it helps us a lot in our investing to dodge. So far, I haven't been a part of any of these downtrends. I'm not saying we didn't start coming back in the latter part of the bear markets, but I've dodged market tops and large portions of bear markets because of this fundamental knowledge and technical knowledge. And the next one is upon us. It's probably unfolding now. And if for some reason it's not now, it'll be shortly. In other words, in the coming months to year. And so you need a game plan so that your wealth doesn't get erased over this next year in a bear market. And many of you that have experienced a 2000 or 2008 know how big and bad those can be. And many of you are that much closer to retirement, or maybe you're even in retirement, and you just can't afford to have a 40 to 60% erasing of your 401k, IRA, your brokerage accounts, your overall net worth. And so you need some help and direction there. So I would encourage you to go to SeanHyman.com. I would encourage you, if you're a subscriber and viewing this, to get the word out and to spread this around on your social media, through email, through any way that you're willing to, because people need to know this information. The next down wave is coming, and most people won't fare well in it at all. But the Bible teaches us to be prudent stewards and to know the signs of the times. And so we need to be aware of what's coming, what the future likely holds, and position our assets to where they can take advantage of that long term. And so pray that's been a blessing to you. Again, help spread this around. It will help save a lot of people a ton of money in the end if they heed what is told. And again, it won't be a quick fix. It won't be get rich quick, because the Bible cautions us against that. You can read in Proverbs where it talks about how money gained quickly goes quickly, and people can have like a pocket with holes in it. And so we're not about quick wealth. We're about true investing, prudent investing. We're about stewardship. And so that's what we're about. And I know everybody that listens to me is not a Christian, is not a believer, but the majority probably are. But whether you are or whether you're not, those principles still hold true. And that's how I steer this ship, is from a very sound numerical fundamental standpoint, and dodging and stepping aside when the risks are really high. So anyway, thanks so much for watching, and God bless. Bye-bye.